Hello, and welcome to Pro Trader Strategies Market Commentary for Tuesday, June the 28th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on because I have a lot of stocks to go over because I was pretty busy yesterday. But as for economic data, today we had final GDP come in at 1.1%, was expected 1%, so slightly higher than expected there. And then we had GDP prices paid index, which came in at 0.4%, lower than the expected 0.6%. And we had the Richmond Fed index come in at -7, which was expected to be a +2. So a big down adjustment there. We had the overall markets up on the day, and we were starting to come off of those highs because of that data point. But let's get on to the markets here. As you can see, crude oil right now up about 75 cents, above $47 a barrel. We came down and basically created a double bottom right here at this value area, which is the point of control. The most time and volume has been spent and has rebounded off of that, so pushing a little bit higher today. Equities moving lockstep pretty much with crude oil today. Here's the NASDAQ, as you can see, up about 63.5 points right now. A little bit earlier today, we had basically regained all of yesterday's losses from the overall market, but like I said, that Richmond Fed manufacturing index came out and put a little bit of a wet blanket on the overall markets. As you can see, /NQ, the E-mini NASDAQ up 62 points on the day. Looks like it's rallying back towards that value area, the point of control where the most time and volume has been spent. As you can see here, E-mini S&P's back above 2,000 today, up almost 22 points. But again, the overall market's starting to show a little bit of weakness after that economic data point. If we look at the E-mini S&Ps on the 15-minute breakdown on the daily chart, as you can see here, this is about when that Richmond manufacturing index came out and the overall market started to slide a little bit. First time it's really shown weakness, even overnight. On to gold. Gold moving inversely related to equities as one would expect. As you can see here, /GC are down about $8 on the day, but overextended is something to note. You know, anytime we get above this value area high, the market is a little bit long in the tooth, if you will. So you would expect that it would want to come back down and trade into the value area and maybe right back to the point of control, which is a magnet, if you will. Onto some trades that I've done. This one was today. The rest of them basically were yesterday. Today in Kellogg, I covered my strangle, and I had on the July 72.5 puts with the 80 calls, and that was a strangle. Now I did this twice because the first time I got in a little bit early, vol expanded on me basically, and I was able to get a little bit more of a premium for selling that strangle. The original strangle I sold, I got $1.27. The next time I went into it, I got $1.90 for that strangle. So all in all, my average on that strangle was about $1.58. I decided to cover that today for about 50% of my max profit on that and covered it for 75 cents. So it finally came in for me as volatility started contracting, and today I was able to cover that for 50% of my max profit. Now on to CMA, or ticker symbol CMA, which is Comerica. This one I had on a strangle also, and usually what I do with these strangles to adjust them is move down the untested side to make it into a straddle, collect a little bit more credit, increase my break evens, and things of that nature. But this has made such a quick move that for one, I wasn't able to collect that much money for the roll down. Plus, I was a little bit worried about a big snapback. This market has seen a massive sell-off in just a couple of days, and I was worried about a snapback to the upside and kind of going through my my short or my short straddle, straddle in that regard. So I decided to go in and do something that I do every once in a while when I see these big moves, is just sell some puts against it when you have a big move like this. I do this with also like the poor man's covered call, for instance. If that were to go against me massively really quickly, then I might just go in and sell some puts rather than roll down those calls right away. So in Comerica, ticker symbol CMA, I went into the July and sold 34 puts for 52 cents because I got that expansion in volatility and decided to go in there and sell some puts rather than roll down those calls necessarily. And as a matter of fact, today I'm looking to take off of those calls because I could probably take off those short calls for less than a nickel. So that is something that I'm playing around with right now. Because at this point, really those calls up there, which are the July 48 calls, are really only going to be able to hurt me if the market ends up rallying. So I might just take those off and let it ride. On to eBay. These are some trades that I just started adding yesterday. I took off my short position, or my short delta position in SPY, and decided to get a little bit long because it just felt like the overall market was kind of getting tired on this sell-off. I also felt that the whole Brexit thing was a little bit overdone to the downside, so I decided to add some long deltas, which means, not necessarily that I'm getting long stock, but I'm actually selling puts. With volatility expansion we saw, I'm waiting for that volatility to come out, and as a matter of fact, some of these, I'm able to get 30% in a day, so I'm going to have a real itchy trigger finger today to maybe cover some of these as well. But with eBay, as you can see, eBay is EBAY is the ticker symbol. I went into the July, sold the 21.5 puts for 31 cents. So if I can get a bit of a rally, that's going to be really nice. The reason why I picked those 21.5s is because that would have been the low, and I really don't see any reason for eBay to really start selling off to those lows. All right, and then on to Las Vegas Sands. This is actually one of those that I'm actually considering covering because it's about 30% of my max profit as we speak, or at least it was a little this morning. It looks like it's coming off a little, so it may not be right there. But I sold some August 39 puts for $1.27. The last I checked, it was trading for under $1, and if I can get like 95 cents or something like that, 92, I think I'm working at 92 cents, but looking for 95, so maybe get out. That's where I'm going to look for a target there. As you can see, we had the volatility expansion, and now it's starting to come off. This was one that wasn't quite 50% of IV percent, I should say. It wasn't quite 50 IV percent, but as you can see, it's just gapped down a couple of times, slammed down, came down to this value area low, which just made it feel like it was a little bit overdone, like I talked about, and would want to migrate back towards that point of control where the most time and value has been spent. Anytime you just see these couple of gap downs like that off of nothing, that was another reason for that. But I don't want to hold on to it forever, just because I am still a little bit nervous about the long side. On to Mosaic. Mosaic's another one that had high implied volatility percent. I wanted to take advantage of the high implied volatility we've been seeing. So in Mosaic, ticker symbol MOS, I went into the August and sold 22 puts for 84 cents. Now that one hasn't really decayed that much and is up a little bit today, but it's pretty close to where I put that one on. IBM, another one, has a high implied volatility percent, as you can see here, looking for that IV to contract if the market continues to rally and push higher. And in IBM, sold some more puts. Went into the August and sold the 120 puts for $1. And those 120 puts, are way down here. That's the beauty of being able to have high implied volatility, you guys. I talk about this so much, is because I can get further away from where the market is and collect a nice credit like I did with IBM. I mean, this $1 credit for being about $25 lower. I just don't see IBM going that far below the value area anytime soon, and it would have to bypass this node just within the next 40 some odd days. So I don't really see that happening. So again, I would expect this to kind of pop back, and if I can cover this for 30% of my max profit in the next couple of days, I'm going to do it, because that's just beating the probabilities. I might not be looking for those 50% of max profit like I normally talk about in these webinars. I actually did a webinar on naked strategies and have the breakdown on the days, and if I can get 10-15% of my max profit within 5 days, I'm going to do that. Well, I'm already at 30% of my max profit on several of these, so I cannot allow that quick move to happen and not take advantage of it. It just doesn't make sense on a probability standpoint. Sorry, we're going a little bit long today. And finally, with TLT, this is another one, basically is going a little bit against me. I didn't really see the overall bonds want to rally today. As a matter of fact, if we go back out to the weekly chart, you can see here that as of yesterday, it was looking like a double top here. So I decided to get short some TLT, along with that whole mantra of just getting long deltas in my portfolio. Remember, when I'm getting short TLT, that's kind of adding long deltas in regards to weighting against the S&Ps. So I did the August 147 calls and collected $1 for that. So it also has really high implied volatility. So hopefully, if implied volatility starts going down, even if this starts going against me, I will be able to take advantage of that contraction of volatility. I could be directionally wrong to still make money on this. The other thing is with TLT, it just seems like it's really getting long. I mean, we're at historical highs here basically, and well away from the value area. So I'm looking at it like some longs are going to have to want to at least take some profits up here and hopefully come back down and test this value area high. That's about all I got for you guys today. Friday's webinar is going to be on poor man's covered puts. So timing on that one's probably not as good as the timing on the poor man's covered call, because we've had that big sell-off. That's a great time to start taking advantage of some opportunities with market sell-offs. The poor man's covered put will be great if the market rebounds and we can start adding some short deltas using those. It is a synthetic short stock, if you will. So you've heard of hedge funds using this a lot to balance portfolios, to get short some overbought stocks, if you will. And this is going to be somewhat in line with that. Might even be able to do a poor man's covered put around something like TLT. All right, so that's about all I got for you guys today, other than if you can't take that, take it easy.